This conference will now be recorded.
Okay, I just, when I wrote this one, because I wanted the journal entry types and everything, I just tried to box it all. So these are transactions here, but to me, this is just easier to get through and put your types in and finish the problem. Got it? So if I make your final look like this, would this work out better?
Actually, yeah, I think this one is simpler.
That's what I thought. So an additional investment in the business, what type is it?
Type 1.
Type 1. So we'll keep it. Paid salary expense, which included $4,000 accrued from 2018.
That's a type 9.
Type 9. Sales on account.
Wait. 6.
No. On account.
12.
No, because it's a sale on account. That's closer. What's the only other one it could be then that you learned early on?
15.
15. Thank you.
Damn. So we scratch that one.
Yep. Don't scratch it. So, as I was writing the problems, I just said, well, hey, let me try this format. All right, cash sales. Type what?
Type 2.
Thank you. Type 2. Income received in advance.
Type 4.
Purchased land cost 500,000, paid down 100. Long-term note. I just put a question mark there.
Wouldn't that be like 7 and 12?
Okay, so you're right. So we're gonna put a type 7 here because that's using cash, but we buying the land, and the cash part is that. But then we also use this note. So how much is this note gonna be?
$400,000.
100,000.
That's gonna be a type what?
12.
Type what?
12.
No. 5. What's happening here? We got a note to buy the asset, and we want to show the whole asset. We don't want to show 100,000 what we paid down. So let's see. So I got this column to the right in terms of the location now on the template. So template location, and we know there's 1, 2, or 3. So So this item would be in what part of the template? Journal entry 1.
Can you repeat that again?
That's 3.
Oh,
Okay, this one would be in part what?
wouldn't that be in type 1?
Type 1. That goes nowhere. The cash sales gonna be where?
Type 1. I mean, yeah, 1, template 1,
Okay. Type
template 1.
So when we purchase the land, the 500,000 is gonna go in what? Part 2. And the note is gonna go in what? Part 3. So the note becomes a source in part 3. So it nets back to this 100,000, but you're showing the fact that you bought it and you used the loan, so you kind of bought, you got to pay it back. It's kind of a different way of looking at it a little bit. But you bought a $500,000 asset and you used the loan to get part of it. Supplies purchased on account, what type is that?
Type 15.
Oh,
No, my bad. I'm in type 12. Oops. I'm sorry.
And we're going to do what?
Cross it out.
Collections on sales on account.
Type 3.
Type 3.
Where is that going to be located?
1.
1. Payment on accounts payable.
Type
8.
8.
8. Where is that going to be located?
1.
1. Paid dividends.
10.
Type 10.
10. Where is it going to be
3.
located? Paid on long-term note. From what?
One.
No, you're paying.
Oh, 8.
It's going to be 8.
And interest will be 9.
Be 9. Let's get our locations. Long-term notes going to be in what? Part 3. And interest is going to be in part 1 because it's an expense. So Chelsea, how this looking now?
It looks fine.
Appreciation, we said that was type what?
Depreciation was a type 14. So you're gonna cross that out.
We're going to scratch it. Supplies on hand. Is that a type 13?
Yes, type 13.
And we're going to do what?
Scratch it.
Paid salary expense for the year.
9.
What part?
1.
Gain order income earned. So you begin to earn your income.
Wouldn't that be a type 2?
Nope, you earned it.
Oh,
4.
Here's where we got the income in advance. That was type. Now you deliver the gains. You already got the cash.
Isn't it 6?
Oh,
Then I don't.
okay. It relates to 5 where you got this income in advance.
oh,
That was a type 4. Now you remember we looked at adjusting and we said adjusting entries never involve cash. So this is adjusting entry type what? 2, right?
yes.
Income where you earn the income. We had a preceding entry where we got cash. That goes on the statement. But when we earn it and we just deliver the items, we can now transfer from that liability account to revenue. What type is this going to be? Look low down on those types. What type is it? Somebody don't have the sheets.
Oh, type 2?
No.
Oh, no, that's not true. That's not true. 4.
Go to the bottom of the types. You got your type sheets?
Yes.
What's near the bottom?
Near the bottom, that is.
Journal entry type near the bottom. What's on there?
Hold on, give me a second.
Let me turn all the way to the types.
I only have types 1 through 18. Is it type 20 that you're talking about? Because those are the only 2 types I don't have.
Yeah, I have 20.
What is 20?
Complete of earning.
The what?
Completion of earning process.
Yep, that's what it sounds like to me. Go down to the bottom. Since
Oh,
it's not
that was
level,
not nowhere near.
they're going to strike it. Accrued salaries at year end,
That's an adjusted entry, right?
correct?
Isn't that a type? Wait. You said accrue.
13?
I thought that was type 18 or 19.
What does it say?
I think that's 13 because that's an adjusted entry.
It's an adjusting entry. I think we have a type in there for it.
13.
Cause okay, 13 then.
What does 13 say?
Utilizing assets would transfer to expense adjusting entry.
That's
You right.
that's the supplies.
Oh.
To the bottom again.
Oh, 19?
What does 19 say?
Accrual of an expense.
Accrual of an expense.
Yes.
That's what.
And since it's not 1 through 11, what we got to do? So this is 19, right? What we got to do?
Cross it out.
Match it out. Cash sales refund.
Type
Number
11.
11.
So what part is it going to go on?
One.
That's correct. Credit sales refund.
Isn't that also a type 11?
No, because in this case, a patient with a credit, you refund, you didn't get cash back. So it's like a credit return. I don't know if we have a type in there for it.
Yeah, I don't think we do.
Thank you, Ebony. But you would scratch it. Bad debt expense.
Oh, bad debt expense, isn't that type 17?
Take your word for it.
Oh, type 17 is a bad debt
And that is
expense.
that is right.
We know we're gonna do what?
Scratch,
Cross it out.
cross it out.
Okay. Cash proceeds on the sale of a fully depreciated automobile.
Isn't that type 14? No.
Yes, that's the type 14.
Oh.
So cash proceeds, you got cash. You got cash.
Oh, so wouldn't we just like scratch like half of it?
No, you don't scratch any of it. You got
Okay.
so you need to find me a journal entry type 1 through 6.
I think the only thing I could think that it could be is type 2.
Yeah, probably a type 2.
No. Find me another one.
6?
6, that's sale of a long-term asset.
Oh no.
Yeah.
Oh, it is?
Sales of a non-current asset.
Yeah. Auto, non-current asset.
Oh,
Oh,
okay.
oops.
Auto is non-current.
They are non-current.
And what part is it gonna be in?
1?
No. Where might it go?
3?
No.
2.
Oh, so it's financing? But how come it's a financing?
It's
Yes.
uh there's cash and investment. These are all long-term assets. So if you sell a long-term asset, it's a source. If you buy a long-term asset, it's a use, which we like the company to do. And remember we talked about the fact, what's going to happen if you sell your car, go to Vegas? That's a long-term asset. So when you come back from Vegas with no money, what's going to be the case?
You gonna be broke?
You won't be able to get to school, you won't be able to get to work or nothing, unless you bum and rides. So when a business does that, it's kind of the same thing. If Macy's begins to sell its stores, and this is ignoring online sales, and they're not going to have those locations, and they're going to have a way to get money into the company because they won't have stores of people buy the stuff. So whenever it's a non-current asset, we particularly concerned. See, Macy's is supposed to be selling clothes. They're not supposed to be selling stores. So if Macy's begins to sell clothes, stores, we want that. We don't want that in operation. We want that put here. So we say, uh-oh, they're selling their stores. How many are they gonna sell? Are they gonna go bankrupt? Got it? So you're always concerned this is positive as opposed to negative. No different from you selling your car, and then you coming back and think you're going to operate, and you don't have a car in Houston. So that's a good review problem. Thank you, Ms. Chelsea, for suggesting that we go over. And so this shows you to review a problem like this. You're reviewing journal entry types and everything. Now, I would assume you all can do the statement of cash flow now, correct? Would that be a valid assumption?
True.
Can you say that again? I'm sorry to hear.
Can you now do the statement of cash flow? We'll work on it. We'll
Yes, I
look
think
at
this sheet is actually easier to use.
say what?
The second sheet that you show us, I think that one is much more easier to use.
I agree. And all you got to remember is that 1 through 6 gonna be on the source side, 7 through 11 gonna be on the use side. You got to put it in the right part and everything. So I was writing this journal, this problem, and I thought I would put it in this format. And so you can always do this, or you can put columns in like this when it's boxed. So if I give it to you in boxes like this, you can always add these yourself, okay? But I'll try to put them in this format so that you're going through, you can put your journal entry types down and locations and things like that. So we'll look at this in office hours tomorrow. Okay? Okay.
Sir,
Professor Boyd,
Yes.
what time is office hours tomorrow?
I guess I really meant Thursday at 2 o'clock, but we can
Oh,
look at, I meant Thursday at 2 o'clock.
okay. Thank you.
Okay. Overview of accounts in the sales and collection cycle. So we covered cash, and when we covered cash, we looked at the statement of cash flow, which we just looked at, and we also looked at the bank reconciliation. So now we're on the accounts receivable, where we make the sale. If it's a cash sale, money goes straight to the bank. But if a sale on account, it goes in the account receivable, and then we got to collect the cash when it's sold on account. Then it gets in the cash. Sometimes people gonna return things. So here's that sales return and allowance. And then some people not gonna pay us. We got to put money in bad debt expense. When you sell for cash, you don't have to worry about any bad debts. But when you don't sell for cash, you got a problem. So let's assume that this company has two transactions. So here's a cash sale, here's a sale on account. And that matching principle requires that we make an adjusting entry. So we're saying we're JHJ Shoe Store and we'll be selling shoes on Thursday. And we have cash sales of 400,000, credit sales of 600,000. So you should remember that the cash sale, type 2, debit cash credit sales. Then the credit sales, type 15, debit account receivable and credit sale. But we know from history, 10% of the people not gonna pay. 10% of the people not gonna pay. So we just take 10% of the credit sales, debit bad debt expense, credit debt allowance. So that was that adjusting entry that some of you all had on your study problems. So all you do, take 10% of the sales, no big deal. Balance sheet presentation. we show account receivable less the allowance for bad debt to get the net account receivable. So what kind of account is the allowance for bad debts? It's going to be a contra asset account. It has a credit balance. Most time asset has debit balances, but the contra accounts like this and accumulated depreciation has a credit balance. So the receivables are not worth 600, they're worth about 540. Got it? Any questions on this? So we make the 15, but whenever you're selling things on credit, you need a 16 too for people who are not gonna pay. Because you don't want the
So,
asset on here at 600, they're not worth 600. Yes,
so anytime you see a bad debit, that will be like a subtraction.
yeah,
Okay. And that will be from account receivables, right?
correct.
Okay.
So let's see if I have any. So here we do the percentage credits, percentage of sales again. The sales were 500,000. And the bad debt was 10%. So account receivable has a debit balance of 400,000, and there's 15,000 already in the account. So the allowance account has a 65,000, and the bad debt expense for the current year is 50,000. So we already have that amount in the account. So I'm just showing you two accounts: account receivable, debit balance of 400,000. The allowance account had 15 in it from prior years. Now here's another 50,000, so it's 65,000 in the account. And we would show the receivables less the amount of bad debt. Any questions? So just the same thing. This is not a big deal.
It will be just a small subtraction.
Say that again.
So we're just looking at a small subtraction.
Yeah.
Okay.
Sometimes people age the accounts. So they say, well, 0 to 30 days, we think we're gonna get most of them, but as accounts get older, it's less likely that they will be collected. So the company estimate, if I age this, the 400,000 only worth 85. So when we age the accounts, we debit bad debt expense and credit the allowance. But in aging, we're gonna take into account 15's already there. So when we aged them, we came up with 85,000. As what we thought would be uncollectible. But when we use that aging method, we take into consideration what's already in the account, and the AJE is the difference. What amount do we need to put in there to bring it to 85,000? Whereas when we're doing the allowance method, a percentage of sales, we didn't worry about what's in the account. We simply took 10%. So percentage of sales or credit sales, you just apply your percentage and you're done. But if you do an aging, you got to look at what's in the account already, and the expense is the difference. So that's the difference in those approaches. And so we should have some problems to work on there. So I want you to take a couple of minutes and look at multiple choice questions 1 and 2. and 4. So let's just see if you do 1, 2, 3, and 4, and I'll move it up, whether we have some entries there or not. So 1, 2, 3, and 4. And there's your answers for 4 there. But I'll move it back in a few minutes. So go ahead and do 1, 2, and 3 and see if you can answer those. I assume you all are finished with 1. Take about 5 more minutes. You only got 2 calculations to make. Are y'all finished?
I think we're good.
Oh, okay. Let's look at the first one. An agent of the account indicates that 5,000 are estimated to be uncollected. If the allowance account has a 3,000 debit balance, the adjustment to record the bad debt for the period will require which one of
B.
those answers?
Wouldn't that be B?
No.
But how come it's not B?
Well, when we're making the adjustment in general, we said that we always credited the allowance. though. That's one of the reasons.
Oh,
So you get a chance to change your answer, but you're on the right path.
well then it's D.
Oh, you got off the path.
Oh, sheesh.
Isn't it A?
Tell us why it's A, Chelsea.
It's A because bad debt expense is debited. Because you just showed us the example of the exact.
Let me put the account in here. And it says the account has a debit balance of what? 3,000. So you're on the right track. And it says indicates that 5,000 estimated to be uncollectible. And so if the allowance account has this 3,000 debit balance, and you got to now get it to 5,000, you got to come up with a balance of 5,000. So what's your amount got to be to get that balance of 5,000? The AJ has an $8,000 credit, and you would debit bad debt expense 8,000, credit the allowance. All right, so we had a little problem with that one. What about number 2?
Can you highlight A? Just highlight it, make it look pretty.
Okay. How's that?
Well, I said highlight and you bolded it, but it's okay. It's still noticeable.
All right. What about number 2? What's the answer? Let's try D. So we hadn't exactly talked about that, but adjusting, but we talked about matching in an adjusting entry. And so we want the bad debt expense to be recognized in the year of the sale. Because we don't want to say sales is such and such when part of them are bad. So you're going to deduct that expense that year. All right, so that was a little off. What about number 3? Oh, we should better get that one right. Y'all don't want to think today. So which one? Give me a guess.
A.
Let's go over and look at the entry again. So this is the entry we make. So give me a guess again. Once again, this
C.
is, say what?
C.
Debit to the left. Let's see. Now you guessing all off today. There's 2 more, Ebony.
Um, Well, I'm guessing B.
I mean, didn't we debit bad debt expense and credit the allowance?
Yes,
So
but
Okay, okay.
yeah. When we
debit
were
bad,
going like back and forth, I didn't see the journal entry.
that's why I went to the journal entry.
Yeah, I know, but I was in the restroom, so I was like back and forth.
Oh, okay. All right. Tell me about number 4 then.
Okay, I'll try.
All right. Give y'all one more chance.
Is it B?
That looks the balance in the account is 6, the expense is 45.
It's 40. Mm, okay,
Great job.
thanks.
Okay, so they got a few more of these in that handout, so look at those. We'll be on inventory. We'll be selling shoes on Thursday. Does everybody here own a pair of shoes?
Yes.
Indeed.
Now you can sell some shoes for a shoe store, run a shoe store, and sell shoes.
I know people
Yes.
that.
Everybody say they can do it. That sounds good. So let me get through that. Page that one. So before we sell these shoes, we want to do a little bit on depreciation. A little bit on depreciation and non-current assets. Then we come back to inventories. So in the balance sheet, you have at the bottom on the asset side, non-current assets, property, plant, and equipment. So cash is current all the way through investments. Okay. But then the next segment is property, plant, and equipment, non-current assets. Building, land, machinery, leases, leasehold improvements, and the related accumulated depreciation, which is a contra account, which reduces the amount. Then you have intangibles, goodwill, patents, and trademarks. So it's current assets, then it's long-term assets, property, plant, and equipment, then intangibles. We haven't talked about intangibles that much, but they're not current assets. So one of the big things you have to do is to depreciate non-current assets, and that's an adjusting entry. And so we buy something, it goes down in value, so we got to take some depreciation on it. There are a number of methods of depreciation. We only going to look at 1 and 2, and we talked about them a little bit before: straight line and declining balance. And the others are simpler, but we just want to get 2 methods. But there are 4 methods, and there can be other methods, but 1 and 2 are prevalent. When we're doing straight line depreciation, let's look at how depreciation works. You buy the car for $4,000. In year 1, you take some depreciation, and it's down to being worth $3,000. In year 2, you take some more depreciation, it's down to $2,000. In year 3, you take some more depreciation, it's getting worth less than yes, and then by the end of year 4, it's worth nothing. So you had a 4-year car, and you drove it all over the place, and it went down in value to where it's worth nothing. So if we were doing straight line depreciation, when we bought the car, we debited equipment. Let's just say we paid cash for $4,000. A debit auto credit cash for $4,000. When we record depreciation the first year, we debit depreciation expense and credit accumulated depreciation. That's a contra account. So when we get to the long-term assets, we're gonna have equipment less accumulated depreciation. The car worth $3,000. So that's what we're showing. We're showing this car is only worth $3,000 with this entry and then this balance sheet presentation. When year 2 occurs, we make this same entry. We debit depreciation expense and credit accumulate depreciation. But now the car is only worth $2,000. Equipment $4,000. You've taken depreciation for 2 years. So now it's worth $2,000. Okay? And we continue doing that every year. In year 3, we make the same entry. The accumulated would be $3,000 and the car would be worth $1,000. Then in year 4, we make the entry again, same entry. The car would cost $4,000. But the depreciation would be $4,000. And the car would be worth $0. Any questions on that? Any questions? Okay, let's look at an example of straight line and double declining balance. When we do straight lines, we determine the total cost. We reduce the cost by the salvage, if any, and then we divide the resulting amount, getting the rate by dividing 100% by the life. That gives us our depreciation rate. So when we're doing straight line, we're writing off 100% of the amount. So let's look at an example. Suppose we had a car that cost $50,000, salvage 10, life 10 years. Let's see if we can fill this out. The car costs $50,000. The cost minus the salvage gets it down to 40. Okay. To get our straight line rate, we simply are going to divide 100% by the life. So the life that's in here is 10 years. Okay. So that means we're writing off the cost minus salvage at a rate of 10%. So 10% of 40 gives us an expense of $4,000. And the accumulated depreciation is $4,000. When we get to year 2, the first 4 columns stay the same. Cost, salvage, straight line. The only thing changed is this column, where now what's going to be in column 5? 8,000. If we go to year 3, so in year 1 we're doing this, then this is year 2. Now we go to year 3. I don't know why I did that. I didn't do it. So we go to year 3. All of that's the same again, except this column. How much is it going to be now?
12.
12,000. So that's straight line depreciation, very simple. costs. We reduce the cost by the salaries to get our depreciable amount. Then we divide the life 10 years into 100% to get a constant rate of 10%. So, and once we start it, it stays the same. Are there any questions on straight line depreciation?
No, sir.
Well, let's go to double declining balance depreciation. In double declining balance, instead of dividing by 100, we're going to divide by 200% because we're writing off more. Okay? But we're going to reduce in year 2 the cost by how much we've written off the prior year because we're applying our rate, a higher rate, to a declining balance. And we continue to do that. We ignore salvage. So if we had the same problem, we're doing DDB, we start off with 50,000. We hadn't had any prior year depreciation, so the book value stays at 50,000. Now, rate now is going to be 200% divided by the life, so it's going to be 20%. Percent. So our depreciation is going to be 20% of 5,000. So it's going to be how much? So when we use double declining balance, we are writing off more early. Straight line is 10% a year. So now instead of the accumulated depreciation being 4, it's going to be 10,000. But let's notice what's going to happen when we get to year 2. Cost 50,000. Our book value is going to be found by subtracting from 50,000 the accumulated depreciation from the prior year. So we're going to subtract 10 from 50. We're going to get 40,000. Now we're going to apply our 20% rate to the 40. So 20% of 40 is what? 8,000, right? So now our accumulated depreciation is 8,000, 18,000. So we're depreciating the item much faster. Straight line, we're taking 4,000 a year. Double declining balance, we're taking 20% a year, and we're starting off with more. Eventually, we're going to have less. So you all go ahead and do year 3. Calculate that depreciation for me and tell me what it is in year 3.
So wouldn't it be 50,000?
Then 30,000.
Right.
Is that right? 30?
I did 30.
I had 40 minus, oh wait. It's not 30. It's isn't it 32? Yeah,
32.
32. And
So
then
the
it's
easiest
20.
might be is to come up here to the accumulated amount and subtract. You can do it several ways.
Okay.
Now, so I just go and I just take what's on this line for the prior year and I subtract it. Still at 20%. So what's our depreciation in year 3 going to be?
Six.
How much?
No. Hold on.
You starting out okay.
6,000.
6,400.
6,400.
Oh yeah. Okay. Can you? Okay. I don't understand why it's 6,400. Can you explain it to me?
You're taking 20% of this number, whatever's in the book value column.
Okay. Gotcha.
Okay.
I'm gonna insert a row above, and I'm gonna label these columns.
Aw, you're so sweet.
And I'll go ahead and try to center them. Okay. So to get our expense, we get in to get the expense, always going to be parentheses. It's simply going to be what?
Book value times 20%.
3 times 4. So to get the amount here, we are simply multiplying whatever's in 3 by this percentage in 4. Now let's talk about the book value. The book value is always the cost minus what?
Minus
The
5.
minus 6.
Oh,
minus accumulated depreciation. Line 6. But for the prior year. So if you remember, when we first buy that, accumulate depreciation for the prior year is 0. That's why I went 50. But in year 2, we go to line 6 for the prior year, 10, and we subtract it out to get 40. So when we get to 50 to get the book value, we're going to take what? The cost, which is line 2, minus accumulated depreciation for the prior year, 18. So what's our accumulated depreciation now at the end of year 3? Is that 24,400 maybe?
24,400.
You all do year 4 then. We'll be about ready to call it quits. You all do year 4.
So first number will be 50,000
50,000 again.
Then it will be 25,600.
You got 25,600, 50 minus the 24 from the prior year. 20%, correct? So what's going to be in this
5,120.
5,120, which is 20%
Yeah.
the amount in column 3. So what's our accumulated depreciation now?
29,120.
Okay. So you all can finish this out over 10 years. So I want you all to go and finish 10 years for me. Do both. Do straight line and then do this for 10 years. Okay?
Yes.
Okay.
Gotcha.
So that's not hard. This is easy stuff right here, right through here. All right, y'all need to read this a little bit. We're selling shoes. And when you sell shoes, you're getting cash or receivable. So you got a 2 or 15. There are 3 entries involved. Okay, here we were just selling, this is when we were selling our service business, renting out cars. But when we decide to sell inventory, we got 3 entries. We got to buy the inventory. We always buy inventory on credit. We don't pay cash on inventory. We got to check to see if it's there, make sure it's not damaged. So we're selling inventory and we don't want to pay the delivery driver. So this is the entry we make. Then when we make the sale, we debit cash or account receivable and credit sales, but we keep in track of the inventory and we're going to debit cost of goods sold and credit inventory because you don't want people in there trying to buy stuff that's not there, especially if people buying online. If an item is not there, they need to know, so we take it out of inventory. So here's our new income statement: sales, less sales return, net sales, less cost of goods sold, gross profit, less the operating expenses, net income. Okay, so the income statement changes up a little bit. We want to know if what we sold, that there's a profit. Then we're going to subtract all of those operating expenses to get the net income. And we will be selling 1 shoe. We're going to start off selling 1 shoe. The shoe costs $20 and the selling price is $50. Can y'all sell 1 shoe?
Yes.
What's journal entry to sell that 1 shoe?
Mm,
You got to buy it first, right?
yes.
So we're going to debit inventory, credit account payable for 20. Then when we sell that 1 shoe for 50, we debit cash or account receivable credit sales. Then we make another entry, debit cost of goods sold, crediting inventory, and our income statement, sales less cost of goods sold, gives us a gross profit of 30. So we're going to pick it up here next time with this example as we're selling these shoes. But you all are convinced me that you can sell these shoes